My name is Jake. Welcome to the channel. 15 years ago, I was first learning about investing. I didn't really know what I was doing. I just knew that investing was probably pretty important for my future. So what did I do? I went online. I tried to research as much as I could. I would ask other people, hey, how do you invest? Or, hey, have you ever looked at investing? What are you doing? And so I would always get recommended to go and watch a podcast or watch, a pretty popular individual who would talk about investing. They would talk about mutual funds. And I got really excited about the idea of investing. And I would watch this individual, and this individual would always talk about, you have to buy the best growth mutual funds, buy the mutual funds that are outperforming everything else. And that would at first get me really excited. Okay, I have a plan. I know what to do. But then when I would look a little bit deeper and think, okay, well, what does that mean? What mutual funds? What investments? What do I actually invest in? And there was no advice when it came to what actual investments to purchase. And that left me very confused and frustrated because I didn't really know what to do. And so lo and behold, I didn't end up really doing anything. In fact, I actually did the opposite. I actually would go and try to time the market. I would invest into penny stocks. I would day trade. And it didn't really click for me. And fast forward about 10 years later, I'm just about 29, 30 years old, and I'm learning about, financial independence. And I stumbled upon a book from J.L. Collins called The Simple Path to Wealth. And what resonated with me with this book was J.L. Collins was actually suggesting an actual investment that I should consider going out and buying if I wanted to reach financial independence. And that really resonated with me because I would always think I have to overcomplicate things. I have to have everything perfect. I have to only pick the winners. I can only pick the best stocks, and have to have the right mixture of everything. After reading this book and learning about the simple path to wealth, it really I don't know how else to describe it, but the way that I would describe it is there was like this peace that came over me. It was like, wow. All this time I was trying to figure out, have the perfect sauce, have the perfect mix. And I had to only pick the winners. I had to pick the best mutual funds because all of the years leading up to this, I was all over the place. I was investing into penny stocks, losing money left and right. And it looked a little like this. Oh my gosh. I'm sure a lot of you out there watching this video, you probably can relate. So I want to talk about the simple path to wealth with dividend investing. And this entire video is from inspiration from J.L. Collins. I get asked all the time. I read all of your comments. I talk to people, whether it be at work or people that email me and ask about, hey, Jake, I love what you're talking about, but I just feel like I just need it simple. Just help me understand what is the simplest way to become a quote unquote dividend investor to live off of my dividend portfolio. What's the easiest way? And so when I get these questions, I thought to myself, well, what's the best way that I can recommend, for somebody that, may not confuse them? And then I thought back on my experiences, 15 years ago when I was learning, buy the best mutual funds and then you're set versus what I learned from J.L. Collins. So I want to share with all of you, if you're watching this video and you're thinking about becoming or building a dividend portfolio or reaching financial independence with dividend investing, I am talking to you. I'm talking to you and trying to help you understand what you can do to make it as simple as possible so that you can reach financial independence with dividend investing. So to start off with, what does it mean for it to be a simple path? So there's some life, pieces in here that the J.L. Collins talks about. I'm not going to go into every single one into detail, but I would highly encourage you, if you're thinking about dividend investing and you're a brand new investor, go and look up J.L. Collins and look at his view on the simple path to wealth. When you go on YouTube and you look up finance videos and, investing videos, and you see all these gurus online, and they talk about all the greatest things. You buy this crypto coin, you buy this NFT, you buy this growth stock, and then you'll be a millionaire tomorrow. That's not the real world. I'm sorry to break it. I'm sorry to, disappoint you, but that's not the real world. And I think for the majority of you watching this video, I think most people are going to benefit more from the simple path than trying to, skip the line and try to get ahead and, cut corners. Okay. So highly encourage you to check out this blog from J.L. Collins, because what I'm going to talk about is really inspired from him. So the big point of the Simple Path to Wealth from J.L. Collins is to buy VTSAX. This is the Vanguard Total Stock Market Index fund, or VTI is the ETF version. And so if you're reaching, if your goal is to reach FIRE and you want to focus on the 4% rule, this is what you do. You buy VTI. Okay. If you want to be a dividend investor, my suggestion is that you take a similar approach. And let me share with you what my approach would be to the Simple Path to Wealth with dividend investing. My approach would be very similar in that instead of going and purchasing VTI, where VTI is the total US stock market, you have, companies in there that are growth stocks, value stocks, you have unprofitable stocks, you have, profitable stocks, you get everything lump summed into one index. What I'm proposing, if you want to be a dividend investor and you want a simple path to wealth, my recommendation is to buy SCHD and DGRO as often as you can, whenever you can, and to hold them forever. So let me say that one more time. In my opinion, the simple path to wealth with dividend investing is you buy SCHD and DGRO as often as you can, as much as you can, and hold them forever. This is a similar approach with the traditional FIRE movement with the 4% rule with VTI, but it's a little bit different because you're never going to sell your shares. You're not going to liquidate any shares. You're going to live off of the dividend income every single month in retirement from these two ETFs. So let's talk about it. Let me share with you, what these two ETFs are. Let me talk about a few different time horizons. If you're a subscriber of the channel, you hear me talk about time horizon all the time. I'm going to walk you through from start to finish how I view the simple path to wealth with dividend investing. Okay, first off, I would never recommend anything that is lagging or not comparable to the overall index, whether that be the S&P 500 or the total US stock market. So what I want to make sure is if I'm recommending something, that it is comparable to the total stock market. Okay, so let me walk you through some of the things that we're going to take a look at. We're going to look at some things here in Seeking Alpha. I'm a huge fan of Seeking Alpha. They actually support the channel. If you want to subscribe to Seeking Alpha Premium, I'll leave a link in the description below. Some of the stuff that we're going to do here, you can't do with the free version. You'll get 58% off your first year with my link. I want to be very transparent. I do benefit from it, but if you don't want to do it, no worries, no pressure. So what we're looking at is we're looking at the price return of VTI, SCHD, and DGRO. And really quick, if you're brand new to this, and if you don't understand what SCHD is or DGRO, I will leave a link in the top right to two videos. I go into detail and I talk about what SCHD is, what is the index, everything that you would need start to finish in one video, and I do the exact same thing with DGRO. So I will leave a link to both of those videos. You can check out those videos around those two ETFs. So you can understand more clearly what they actually are, because these two ETFs, they follow different indexes or indices. And so you're getting a little bit of a different, mix, and I'll explain here in a moment, some of the reasoning behind why DGRO and why SCHD. So just looking at the total returns here really quick, just looking at the price. So if you were to go to Yahoo Finance or Google Finance and type in the tickers, this is what you're going to see. You're not going to see this with the dividend reinvestment. So what I want to look at is I want to look at the total return. The total return is with the dividend reinvested. So with the dividend reinvested, DGRO and SCHD are actually outperforming VTI. But the special thing about these two ETFs is, one, they have low fees. They're not as low as VTI, but they have very low fees. The second thing is they're very tax efficient. There are no real estate investment trusts in here, so they're very tax efficient. So these are the reasons, a few reasons, why I absolutely love these two ETFs and why I'm proposing that the simple path to wealth with dividend investing is to buy DGRO and SCHD. So I want to take a really quick look at back testing these two different portfolios. And I want to show you, just as an example of what the returns would have looked like historically. These are actual returns if you would have been an investor in VTI versus SCHD or DGRO. So portfolio 1 is going to be VTI at 100%. Portfolio 2 is going to be split 50-50 between SCHD and DGRO. So you can see here, VTI, the total return had a CAGR, compounded annual growth rate, of just under 10%. Portfolio 2 with DGRO and SCHD had a return of just over 11%. And so you can see that these two portfolios, they're so similar. And that's why I feel so confident in suggesting this, is you're almost getting market returns, but the distribution between the capital appreciation and the dividend is slightly different, more in favor of the dividend income, which all of you dividend investors value. And I'll show that here in just a second. When looking at this, at the annualized returns, the up and downs, you can see that they're pretty comparable. And so you can see that represented in the annual returns of the two different portfolios. Once again, the blue being VTI and the red being DGRO and SCHD. So now let me talk about why I'm suggesting SCHD and DGRO. Many people here on YouTube just talk about SCHD and that you only need SCHD. Let me explain to you why that's not the case, or why you should consider adding, an ETF like DGRO, okay? For example, if you compare SCHD with VTI, you're only getting 10% of the weighting of the total US stock market. That is not a lot. And let's be honest, no one can predict the future. I don't believe that this is, in my opinion, this is just not real representation of the market. And in my opinion, I don't personally like that. And so what I would suggest is adding an index or an ETF that's focused on dividend growth, which DGRO is, that has a quality aspect to it, focused on the payout ratio and so forth. You can watch my other videos to understand specifically about these two ETFs, but let me show you why I'm suggesting DGRO. With DGRO, you're getting more market participation. If you just invest into SCHD, you're only getting 1/10 of the market. And so by having DGRO and SCHD, you're getting a larger, you're getting more exposure to the overall market, which in my opinion is a positive. And then if you compare DGRO and SCHD, you can see that they do have fund overlap, but it's just 1/4 of the overall weighting. And by combining DGRO and SCHD, you're getting more exposure to the overall market. So let me walk you through really quickly what the yield on cost would be between these three ETFs, VTI, SCHD, and DGRO. So with VTI, if you go into Seeking Alpha, you go under the dividend section, you go under dividend yield, you can go under yield on cost. And so what I've done is I've filtered it based off of July 1st, 2014. This is with the inception of DGRO. So we're comparing apples to apples. It doesn't help us to compare something, different dates. So that's why we're comparing this date. But the interesting thing here, and for dividend investors, what we're concerned about, what we're interested in, is the dividend growth rate, the dividend yield, and obviously, other metrics like the dividend safety, etc. But the reason why I like DGRO and SCHD is specifically this. With VTI, you're getting a yield on cost. Had you have invested since 2014, your yield on cost is just over 3%. 3% is not very high. Okay, now we saw from earlier, let me flip back to here, we see that the total return of SCHD and DGRO is actually outpacing VTI. And so the dividend is absolutely part of the total return, But with VTI, it's not a focus point. You don't invest into VTI just for the dividend. And because of that, you wouldn't consider yourself really a dividend-focused investor investing into VTI. Whereas with DGRO is specifically focused on dividend growth, and it screens companies that have, a dividend growth focus. Okay. Now with VTI, you're getting both value and growth, companies that are unprofitable that don't pay a dividend and companies that are profitable and pay a dividend. Okay. So with DGRO, we would assume and expect the dividend to be higher. And so looking at the exact same metric, though the total return is similar, you're getting a larger focus or a bigger focus on the dividend yield, and you're getting 50% more dividend growth from DGRO versus VTI. So you're getting 4.5% versus 3% with VTI. Now, the icing on the cake here is SCHD. So SCHD, this is really, the cream of the crop when it comes to dividend growth ETFs. But once again, the reason why we don't have it alone is you're only getting 10% of the overall market, okay? So now, when looking at the dividend growth of SCHD has a much higher dividend yield on cost than VTI. In fact, it has over 100% higher yield on cost than VTI. Okay. Now, this is really the creme of the creme, the cream of the crop when it comes to dividend growth ETFs. So by combining SCHD and DGRO, you're accomplishing a couple of things. First, you're getting more exposure to the overall market with both of them. Second, you're getting lower fees by focusing on these ETFs because they charge a much lower fee than other dividend-focused ETFs. And then lastly, you're getting tax efficiency because these ETFs exclude real estate investment trusts. For those of you that have been following the channel, you've heard me say many times that your investing time horizon really dictates how you should be investing and setting up your portfolio. Now, I want to take an example here from J.L. Collins' blog where he talks about the smoother path to wealth. Now, when investing into the traditional FIRE movement, traditionally you're investing, 100% into VTSAX or VTI. And then once you get closer to retirement, then you would ideally then add a percentage to bonds. Okay. And so this is what he talks about on his blog, that while you're in the wealth building phase of your life, you want to focus 100% on stocks, equities. And then once you're in the wealth preservation of your life, you want to focus a portion on equities and a portion on bonds. And so in light of that, I want to take a similar approach when I talk about the simple path to wealth with dividend investing. Now, instead of recommending bonds, what I would suggest is consider other options that will, where you can get maybe a higher yield than you would with, for example, SCHD or DGRO. And my recommendation is to consider looking at a cover call ETF like JEPI. Now, JEPI has not been around for years. There's not a lot of back testing that you can do with this ETF. But what I would recommend, depending on your time horizon, consider an ETF or a cover call ETF like JEPI. Now, if you wanted to go with a bond ETF, you could absolutely do that. My recommendation to get a larger starting yield would be to go with a cover call ETF like JEPI. JEPI is a high quality, actively managed cover call ETF. It has a lower expense ratio compared to its peers. And I've shared, other videos on JEPI in the past. I will leave a link in the top right here. You can check out a video on this ETF. When backtesting and looking at the historical performance of JEPI since its inception here in 2020, we can see comparatively how JEPI has compared to the other ETFs that we talked about in this video. So when we look at just the price action, so this is what you would see in Google Finance or Yahoo Finance, this is not with the dividend reinvested. You can see that without the dividend reinvested, JEPI has lagged the others here on the list. But when we consider the dividends reinvested, JEPI is actually performing fairly well compared to the others here on the list. And so to quote J.L. Collins, the reason why you would add bonds to your portfolio is to smooth out the ride. The reason why I would suggest adding JEPI to your portfolio is if you're closer to retirement and you want to smooth out the ride, but also you want to increase your yield and you want to have a higher yield and thereby have more income from your portfolio. So what I'm recommending is if you have over a 5-year time horizon, to keep it very simple, the simple path to wealth with dividend investing would look something like 50% into DGRO and 50% into SCHD. Now, if you wanted to have 30-70 or whatever you would want, that's up to you. But my recommendation, if you want to keep it very simple, very straightforward, you want to set it and forget it, my recommendation is to have 50% into DGRO and 50% into SCHD if you have a time horizon of over 5 years. Now, on the other hand, if you have a much shorter time horizon, meaning you're looking to live off of your dividend portfolio much sooner than 5 years, then I would recommend a different approach, incorporating that higher income from a covered call ETF like JEPI, for example. So the simple path to wealth with dividend investing from 1 to 5 years would be, for example, 38% into SCHD, 37% into DGRO, and 25% into JEPI. And so you can see that a couple of things are happening here. Your expense ratio is going up, but also your dividend yield is going up. And so the goal here is by incorporating JEPI into your portfolio, depending on your time horizon, if you have over a 5-year time horizon, you don't ideally want to have JEPI in there because you're paying higher taxes, right? And so, what were those 3 things that I talked about? 1 being low fees, 2 being broad-based exposure to the market, and 3, no real estate investment trust or, qualified dividends, lower taxes. JEPI is taxed a bit different. And so if you have a shorter time horizon, you're going to sacrifice on the tax efficiency and you're going to sacrifice a little bit on the expense ratio. But you're also still going to maintain diversification because JEPI is focused on the S&P 500. So I guess to summarize here, there is a trade-off. And so to make it very simple and straightforward, if you have over 5 years, you would not want to ideally have JEPI in the portfolio. If you have less than 5 years, you could consider adding JEPI to your portfolio. So these 2 portfolios here, I will leave links in the description below. You can check them out and see, what would make the most sense for you depending on your investing time horizon. Now, I know that not everybody is going to agree with what I've said in this video, and that's okay. Everybody's in a different situation. Everyone has a different understanding of what's right for them. I mean, we call it personal finance for a reason. Everyone is in a unique situation. But for me, I truly believe that if you are in a situation where you want to set up your portfolio, you don't want to manage it on a regular basis, you want to set it up and forget it, I truly believe that if you want to be a dividend investor, you want to live off your dividend portfolio in the future, that SCHD and DGRO are the simple path to wealth with dividend investing.
There's an enormous amount of money to be made by Wall Street in making it complex. The money's made in commissions. It's also made in driving people into the arms of advisors who take commissions to guide you through this thing that is just way too complex for your pretty little head. Here's the good news. If you take a mental image of all these different investments and you think of it as food on a huge banquet table, all these incredibly rich and diverse foods, you can put your arm on that table except for one small corner and sweep it all onto the floor. Because if you want to become financially independent, if you want to become wealthy, you don't need the vast majority of it. All you really need is those broad-based stock and bond index funds, and they are the soul of simplicity when you just focus on what you actually need, as opposed to everything that's put in front of you.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.